Welcome back to Investing and Trading Live, sponsored by Trading Academy. As always, once again, I am your host, Josh Lilquist. On the last segment, we covered a few topics on leverage, the importance of leverage, how to use it properly, safely, and then making smart investing decisions with less capital. That's really what leverage will do for you, is being efficient with the dollars that you have available. And we have classes specifically on leverage that a lot of people were texting into, calling into. Congratulations to those that have done that. If you missed it, you can simply just text the word investing to the number 210-210, and that'll be for 2 seats, one for you and one for a friend. Or you can go into investingandtradinglive.com and you can pick your own date there. That's Investing and Trading Live, title of the show. And also, we appreciate and love our subscribers on the podcast, Investing and Trading Live, wherever you listen to podcasts, Apple Podcasts, iHeartRadio, Spotify. And it's also on that website, investingandtradinglive.com. So if you missed part of the show, definitely check out a piece of that. And also the YouTube stream. We're doing this live on the YouTube. On Viola YouTube is what they say. That's what the kids call it. And make sure to check that out. Just go to Josh Lilquist on YouTube. So, Al, in this segment here, it's imperative that people start saving for retirement early. And I think a lot of people just forget about it because they think it's a long-term thing. They say, I got time on my hands, and I'm in it for the long haul. And what happens is the long haul starts to get shorter and shorter.
The long haul is actually a short haul, folks.
Exactly. It keeps getting shorter and shorter, especially if they don't start early enough.
Right.
Now, that's why we talked about in the last segment the importance of using leverage to be able to speed that up a little bit. Right. But we've got a lot of listeners, Al, that do have retirement accounts, and they're concerned about them. Should be at all-time highs, hopefully, or near them. You look at the markets this week, it bounced back after that big drop we talked about on the last segment yesterday morning, bounced straight back up to the upside after that. Now, with those retirement accounts, they want to be able to keep what they have, but then continue to grow that at the rates of returns that they need. Now, stocks provide an opportunity, obviously, but the problem is they're dollar for dollar. You need the physical dollars to buy them. Same thing with mutual funds. Mutual funds are, quite frankly, probably the worst investment you can ever make in a retirement account because of the 4-letter F word that comes along with them. And yes, this is a family show, it's fees. So I want you to talk about some alternative routes that people can take with those retirement accounts, 401ks, IRAs, whatever retirement vehicle it is, to really have that confidence going into retirement, knowing they're safe and secure.
Yeah, unfortunately, most people just become complacent and accept the fact that this thing called the 401k is what's going to get them through retirement, living the lifestyle that they either have achieved or that they want to live. The problem is that most 401ks fall far short of that, and they never were intended to be the go-to for retirement. They were initially put together as a tax haven for high-paid executives, but somehow it's transformed into the go-to retirement account.
By the way, it used to be called the salary reduction program.
That's exactly right. Yeah.
And you change it to a 401k. It sounds beautiful, right?
Yeah. And here's the thing: is the responsibility for the amount of money that was in those accounts and for the performance used to be on the employers when they had pension plans. When the 401ks came into existence, the responsibility transferred to the employee. That's the problem, that most employees don't know how to manage those accounts. They don't know. In fact, most people don't even know what's in their 401ks.
So what can they do?
Well, they first of all can understand what's in those 401ks. And I think this is the reason that what we're talking about here is so important. Over 70% of the people now that are over 55 say that they're either going to have to delay retirement or just postpone it, not retire at all.
70%?
70%.
So 7 out of 10 people are going to delay retirement. That's you and your neighbors and your friends.
Exactly.
Yeah.
And why is that the case? Well, it's the case because they don't have the amount of money that people say you need to have now to live a comfortable retirement. And that number, it has quickly gone from about $1 million to closer to between $2 and $3 million to live comfortably. So what if you don't have it? Do you have it? If you do, fantastic, congratulations. But what do you do if you don't? Well, you can't go through another 30 or 40 years of investing in something that is giving you low returns and exposing you to all of the major market drawdowns. You have to use something that's different. I mean, let's be honest, you have a shorter amount of time to build some money up. You have a shorter amount of time to get the money that you either need or you want to live the lifestyle that you really desire. You do that by using a small amount of money in an account that has leverage. And we talked about that last
So you
segment.
can do that in your retirement accounts.
You not only can you, I think most people have to learn how to do this if they want to have a chance of living a comfortable retirement. Leverage allows you to take a small amount of money but control something much larger. We talked about it in the last section, sort of like a mortgage, where you put maybe $30,000 or $40,000 down and you control the $400,000, $500,000 investment.
Well, let's back the truck up a little bit. Do people need to use $30,000 like that as a...
No.
Okay,
I'm just talking about the mortgage example, just to show you that what leverage is.
Okay, so I want to make sure our listeners understand that you can use much less.
Yeah, and there's two reasons that that's important. One is that a lot of people don't have a lot of money, so they have to start with a small amount. If you put a small amount of money into one or two shares of a stock or a mutual fund that maybe gives you 3 or 4% over time, that's not going to get you where you want to go.
Yeah, 3% is not bad. I mean, that's better than nothing, right? It's 3% on $100,000 is $3,000.
It's pretty much nothing when you
that
pay
gets
taxes.
You a couple Tootsie Rolls, doesn't it?
You're going to pay taxes on that, and you have to deal with inflation, which is around 3%. That brings you to
basically nothing.
Basically nothing.
But let's address that, because people say, well, it's better than nothing. Well, there are other things you can do that's not just better than nothing, but getting the opportunities that you really need to get to retirement.
Yeah, exactly. So leverage is one thing, but you also have to use something that is short term. So again, let's be real, folks. When you are 65 or 70, you can't put your money into something you're going to hold on to for 30 or 40 years.
So let's address that too, because our listeners are probably thinking short term. Oh, they got to be day trading. That's not the case, right?
That's not the case.
Okay.
Short term is relative. You define what short term is for you.
So it could be a couple of weeks, couple of months, even.
It could be a couple of weeks, could be a couple of months. It
Okay.
could be daily. It could be weekly. You decide how often you need that money, how often you would like to be able to access that money. And then a strategy could plan be put together that includes strategies and assets that addresses that time frame and the amount that you think you need. And by the way, a lot of people go into retirement with a plan put together probably decades ago that is outdated, that says, yeah, if you can get maybe 6 or 7 or 5% a year, you'll be just fine. What it doesn't take into consideration is what has changed during that time period. Maybe your health has changed. Maybe your marriage situation has changed.
Well, what if I say there was a sales company that was making cold calls and stuff, and they were still using a rotary phone, but you were told it's still better than nothing. Is that efficient?
Nothing's not so great.
No, so you're going to probably want either a touch phone or even better, a calling system that calls automatically for you. So you got to be in a strategy that's with what's with the times now.
Yeah. Not only that, because things have changed, technology has changed. Not only that, but a lot of people that have 401ks that they put together years ago, and they accepted what they were told to do with it, which is just hold on. Don't worry about crashes or corrections. The market always comes back. What I'm getting at is that maybe you have a lot of investments in your 401k that are no longer good investments because the company that money is invested in maybe is no longer a leader in its industry. Maybe that company is, think about that. Maybe you got a stock in something like Blockbuster or Enron, companies that are either bankrupt or just haven't.
Hey, let me see what the ticker symbol on Blockbuster is. What is that again?
It's question mark, question mark, question
okay,
mark.
So it doesn't exist.
It does not exist.
Exactly.
The same thing with Enron. Enron was, that was what everybody wanted to own stock in Enron at one point in time, not realizing that everything they said was a lie, and now Enron is gone.
Yep. So you need a strategy for with what the times are presenting, the opportunities for now, not the opportunities from basically probably the 1980s, because that's when the 401k started. Late 70s was when the 401k started, 78, 79, and it just kept booming from there. But it was a great deal for employers. Now the responsibility is on you, as Al was alluding to, but that's why you need to use this yourself. direct that yourself is kind of where he's getting to. Use leverage properly. They say don't put all your eggs in one basket. Well, if you have a 401k, I'm sorry, they most likely are probably all in one basket. All mutual funds or stocks or something that tracks stocks. That is one asset class. That is exactly all your eggs in one basket. Why not be diversified in multiple assets with futures and some currencies and some stocks, right? That way, there's ways you can do that with when you direct it yourself. We have classes specifically on retirement accounts, how to direct them yourself, strategies that are designed for today, not for 1980, strategies that are designed for you and the returns that you need and the strategies designed for that. Simply text the word investing to the number 210-210 for this investing class strictly on retirement. Text investing to the number 210-210. When you do that, you're going to get a text right back with a link to our landing page, or you can go straight to investingandtradinglive.com and pick your own seat there. Coming up next, we still got a lot to discuss. Markets are showing really good opportunities again. Just this last couple days here, markets are obviously near all-time highs again. Stay tuned. This is Josh and Al. We will be right back.